Good evening. It's now 6 p.m. and the March 4th meeting of the Dublin Central Services District Board of Directors is called to order. Please join me in the pledge to the flag.
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Thank you. Roll call, please.
Director Johnson?
Here.
Director Von Heater-Leopold?
Here.
Director Govinda Rao?
Here.
Vice President Halkett?
Here.
President Goel?
Present. Thank you. Item 4, special announcements and activities.
Good evening, President Goel, members of the board. I would like to announce the appointment of Michelle Gallardo as the district's Administrative Services Director. In this role, Michelle will oversee the reorganized Administrative Services Department, which includes Human Resources and Risk Management, Information Technology, Safety, Security, and Emergency Preparedness, and Legislative Affairs. Michelle has been with the district for over 18 years and served in a variety of positions, including HR and Risk Manager for 11 years, Special Assistant to the General Manager, and most recently she filled in as the district's Interim Administrative Services Director. Michelle has helped guide the district through organizational transitions and emergencies, including floods and fires, and she is well qualified for this position. So please join me in congratulating Michelle on her new role.
Awesome. That's awesome. Congratulations.
Care to comment?
Oh, what? I just want to say thank you. I am very excited for this role, and it isn't possible without having a great team, and I really appreciate the team. I have stayed with the district for over 18 years because of the people here and the great work that we do, so I'm really excited about this role. Thank you.
Thank you, and congratulations on behalf of this board. It's a position well-deserved. You've done a lot of good work, and I know you're going to continue to do some more good work. So looking forward to everything you bring forward. Congratulations. Would anybody else like to join in and comment? All right. Moving on to item 5, public comment. At this time, those in the audience are encouraged to address the board on any items of interest that is within the subject matter jurisdiction of the board and not already included on tonight's agenda. Comments should not exceed 5 minutes. Are there any speaker cards or members of the public? Seeing none. Item 6, agenda management.
No recommended changes.
Thank you. Moving on to item 7, consent calendar. Matters listed under this item are considered routine and will be enacted by one motion in the form listed below. There will be no separate discussion of these items unless requested by a member of the board or by the public prior to the items the board votes on motion to adopt. Is there a motion to approve the items under the consent calendar?
So moved.
I'll second.
I got a motion by Director Von Heater-Leopold and a second by Director Govinda Rao. All those in favor?
Aye.
Aye. Any nays? Any abstentions? Motion carries unanimously. Moving on to item 8, board business. Item 8A, receive a presentation on the proposed investment management plan. Staff.
In January, the board authorized a 3-year contract with Chandler Asset Management to provide investment management and advisory services for the district. Prior to contracting with Chandler, the district managed its investment portfolio in-house. Chandler is here this evening to provide the board with a presentation on the proposed investment management plan. And I'll turn it over to Ken Spray, the district's finance director, who will introduce tonight's speaker and presentation.
Okay, thank you, Jan. Good evening, President Goel, members of the board. So we have with us this evening Mr. Carlos Oblitas, and he is from Chandler Asset Management, and he is going to give a presentation on establishing an investment plan.
Good evening, board members. Thank you so much for inviting me. My name's Carlos Oblitas. I'm a senior portfolio strategist with Chandler Asset Management. I've been with the company for about 8 years, but I've actually 9, close to 9 now, but in the field for 30. And a couple of those years, I actually had the privilege of taking a break and becoming a finance director at a wastewater district. So I know your business just a little bit, certainly from the investment standpoint. We were engaged by your staff to look at your investment program, observe any types of efficiencies that we can bring to the portfolio, and come up with a plan for addressing various areas of the investment program so that you can have a portfolio that meets the objectives that are mandated by code. Those are safety, liquidity, and return in that order. And then, of course, we're trying to optimize this portfolio to earn revenue. We're in a high yield environment still, though rates have come off a little bit from their tops. And there are opportunities for you to be able to capture higher return while maintaining those objectives of safety and liquidity. If we just look at the monitor before you, this is just a brief overview about our firm. Chandler has been around for about 36 years. We were founded by Kay Chandler. That's the namesake of the company. Kay's retired, but she was a former investment officer for City of San Diego, and also San Diego County. She's been doing this for a long time, and then we've been at it as well. We're California based. In fact, of all the major investment firms that manage local government money, I think we're the only one that is California founded and California based. We're based in San Diego, but I am here in the Bay Area. And I will be your main point of contact throughout this entire process. We work to build customized investment solutions. Investments for local governments are they're highly regulated, and it's a niche business, if you will. Not everybody works in this side of the investments world because it's very finite and very specific in what you can do. But what we do is we build investment custom solutions for our clients. They're meant to further your goals. They're meant to support your overall financial objectives. So it's not a cookie cutter approach. It's going to be specifically tailored to what you're doing at the district. We work as a fiduciary. That simply means that we're an agent on your behalf, and when we come up with our investment ideas and execute them through our resources and processes and analytics and everything else that we do, credit analysis, when we come up with those ideas and we execute them, we have to make sure that your best interest is placed first before ours. So it's not a suitability standard. We're not a broker. We don't carry inventory. We go to the markets and capital markets and purchase these securities and structure the portfolio, rebalance the portfolio, and do all the analytics that I mentioned earlier actively on your behalf. As I mentioned, we've been doing this for a long time. The team that's taking care of you, I'm the second from the left. I'll let you read the names. They're all in your board packet. But the person that's actually doing the day-to-day management of the investment program will be Bill Dennehy. He is one of our co-chief investment officers. So you actually have one of the top team players on the team. I'm part of the investment team. I have a voice in the process of how we will place our portfolios and in what direction we're going to go. Nolan handles a lot of the day-to-day just document exchange and crunching numbers for us, getting our materials ready. Neil is more based on business development, and you may see him every once in a while, but he helps me out on a lot of client service things. We specialize in local governments. A couple slides ago, I didn't mention that we manage about $42 billion. Of that, 90% by dollars is local governments, cities, counties, special districts, joint powers authorities, you name it, even investment pools in other states. We are a nationwide firm, but the bulk of our business is here in California. You'll see some of the cities that we work with. One of them is City of Dublin. That's a large client for us in Northern California. Not just cities and counties, but also special districts, joint powers authorities that I mentioned. A lot of these you'll see water, wastewater authorities, housing authorities, highway authorities, and this is across the nation. As I mentioned, we're California-based, but we do have a national presence. The approach is very holistic. What we do for the district isn't just managing funds. It's looking at the overall investment program and making sure that all parts of it fit, that all parts of it work in conjunction. So it's much more holistic. We're looking at your investment policy and reviewing it annually to make sure that it continues to comply with California government code. So we make those annual updates. work with, we're in the process of working with staff to run a cash flow analysis to identify the optimal balance between short-term funds and long-term funds, because both of those require different investment strategies and approaches. We do credit analysis on every security that we buy. We're not just looking at credit ratings that are published by the rating agencies. We're doing our own work on this. We do comprehensive reporting so that your staff doesn't have to waste time calculating accruals and accretions of premiums and discounts, so that these bonds are accounted for accurately in your books. Obviously, we run the accounting. We're doing broker due diligence, looking at the brokers that we're working with. Education and training is needed, and daily monitoring for risks. Mitigating those risks, implementing risk management policies, and also looking for opportunities to expand this portfolio and earn some more money. This is a breakdown, a very short breakdown of the investment world, okay? And at the very top, you have short duration fixed income, and that's just a fancy term for short-term bonds. And in the middle, you have long-term fixed income. Those are longer, out beyond 5 years, out to 10, 20, 30-year bonds. And at the bottom, you've got other investments like stocks and real estate and commodities. And you may see some of these investments across the board when you look at PERS or when you look at deferred comp programs and things like that. But in your world, in local government space, you're limited to the very top quarter of this table that you're seeing here. You're really, really limited. You're limited to bonds. You're an investor in the bond market, which means effectively that you're a lender and you collect rent on the money that you lend out. And the value of that future cash flow that's fixed, that's coming back to you, that can go up and down. So there's a fair value component of that cash flow stream to you. And that's how you generate return in this portfolio. And we'll always be focusing on those two components, interest income and then the fair value of the overall investments. So you can only buy bonds within the fixed income world, within the bond markets. You can only really buy generally 5 years or shorter. You can go longer, and one of the recommendations that you'll see when we get to the investment policies that we're going to be edging out just a little bit longer. But you generally it's 5 years or shorter. You're limited to the asset classes that are listed up at the top where it says allowed on the right-hand column. And even within those asset classes, you have concentration limits that are placed on you by California Government Code. And even within that world, you have credit rating requirements. The investment grade world, meaning bonds that are considered of good quality, of high quality, is triple B or higher. It goes triple A, double A, single A, triple B, double B, and so forth. Triple B or higher is the investment grade world. Well, you're not even allowed to go to the bottom of the investment grade world. You can only go down to single A or higher. So it's very, very restricted. If you're having trouble falling asleep tonight, go to ledgeinfo.ca.gov and pull up existing California code, and there's a penal code and there's a family code. Well, there's also a government code. If you go under government code section 53601, you can read all about it, and it goes by for a few pages. But it's very restrictive. So within this world, we're going to try to optimize this portfolio as best as possible. The way that we do that is our approach to overall management of an investment program is to think holistically, as I mentioned earlier, and we always begin with an overall deep dive into your investment policy. From there, as I mentioned earlier, there's a cash flow component where we try to determine how much is needed for liquidity and how much is long-term for longer-term investments, because there's two strategies right there. From there, we develop the strategies, and those strategies are specific to you. We've already gone through that process with your staff. And then from there, we take care of the rest, which is the heavy lifting, which is all the stuff at the bottom, the credit analysis, making sure that we're matching your liabilities to the right duration of the liabilities and the assets. We're working with the broker community. When we buy these securities, we're not just buying them from local retail brokers. We're going to the national desks of primary broker dealers. We're buying in large amounts. It's a little bit like buying a roll of paper towel at Costco versus the local 7-Eleven. We get price breaks for the sizes that we buy and allocate fairly across our clients. And then just maintaining the objectives of safety and liquidity, making sure that you have money available when you need it. That's a requirement of code. Making sure the portfolio is diversified and that you're complying with California government code. The last thing you ever want is to have an investment that's not in compliance with code, because you have to answer to your constituents for that, and we take that very seriously. We did look at your investment policy. I won't go into too much detail on this slide because we're going to go over the policy. There's a red line, and we're going to give you the opportunity to ask questions and give us feedback. But generally, I mentioned that there's strategies for long-term cash and short-term cash. Most local governments, when they're not working with a professional investment advisor, simply buy the security, collect the income, and they hold it to maturity. They turn around and then they reinvest when that money comes back, and they pick up a yield. And the decisions on how to place that from a maturity standpoint, from a sector standpoint, and what concentrations to have it in, all those decisions are sort of haphazard. There's generally not a plan around that. But that's a good approach for short-term cash, because that allows you to and when I say short term, I mean money that's needed for immediate liquidity, usually six to 9 months or less. And that's a good approach because you can structure those maturities to come due when you have liabilities that are due, and you time those, and that works really well. But for long-term cash, you have a component of your investment program that's going to be in your investment program, and you're not going to spend down, and it will sit there for some time. And we try to optimize that through a total return approach. So it assumes that we buy everything to hold the maturity if we have to, but it assumes that periodically we can execute sales before maturity to optimize, to perhaps take a slight loss, but reinvest into a higher yielding security, which will pay us back for that loss and net us more money than had we done nothing. So we do that analysis on a daily basis. So the liquidity approach, the short-term approach at the top, that's really income driven. The bottom approach for longer-term funds, we call that a total return. And as I mentioned earlier, we're going to focus on not just interest income, but fair value appreciation. We focus on 4 areas of the portfolio, and now we're getting into the weeds, so I'm going to keep this very high level. When we manage, you don't have to worry so much about this, but when we manage money, we focus on these 4 areas. Some people call these the 4 pillars of fixed income investing. I think of them as levers that we can pull to mitigate risk and to drive return. And obviously, I'm going to start from the bottom. Security selection is just selecting securities with the right credit quality and the names, and understanding that issuer and doing the analysis to understand that they're going to have the ability to pay us back, because this is a loan. Bonds are a loan. Term structure is just how we distribute the different purchases. How much between 1 and 2 years, 2 to 3 years, 3 to 4 years, because how we make that decision can impact the return and also the risk over the long run. Again, sector allocation is easy. How much do we buy in treasury bonds from the United States government versus high credit quality corporate bonds, or for perhaps federal agencies, the agencies of the United States, government-sponsored enterprises? How much of these do we buy in these different asset classes? That's another decision that we make. And the top one is duration. It's a little bit esoteric, but it's a risk measure for us that tells us how the value of the portfolio will react, whether it'll go up or down for a given interest rate shift in the markets. And it's a very important risk parameter for us. And we work with your staff to set that so that we have a disciplined approach. The design isn't to be it's not a day trading scheme. It's not we get really, really short or we get really, really long, but rather we maintain a target, and that target is supposed to work over different interest rate cycles. And the approach that we took is that target should net you better than staying shorter, and with less volatility than going longer, within the maturity parameters that you have set by California government code. Well, now we're getting into portfolio theory. Suffice it to say is that we think about every aspect of this investment program. We went all over all of this with staff. Staff worked with us to develop the strategy, and that's how we're approaching. This is, by the time I had to turn this presentation in, I did have a count of what you have in your investment program right now, and you can see the breakout of the different asset classes that you have in the pie chart. The interesting bit about all of this is that you have municipal obligations. These are muni bonds, just like the bonds that you might issue when you borrow, or the city of Dublin, or your neighbors, or the county. What we did notice about that is that a lot of these issues are on the smaller side, and we like to purchase issues that are a big deal. So rather than buying a $5 million piece of a $20 million deal issued by city of, I mean, you name it, Rio Vista or something like that. We want to buy a $2 million piece out of a $1 billion deal like that's issued, or a $2 billion deal by the state of California. There's more liquidity. You're not a majority lender in that deal, and we look for that. The other piece is that with the federal agencies that you currently own, some have call features, and also and those tend to not do so well when interest rates rise. And I think, I think we're all aware that you experienced a significant rise in interest rates in 2022, which caused that component of your portfolio to drop in value significantly. And we're going to be putting together a strategy to work our way through some of those and replace them with higher yielding bonds. We like that you have corporate notes. There are a couple of asset classes that are allowed by California code that you don't have your investment policy that we do work in, and we have strong capabilities in analyzing and mitigating their risk, and we're going to ask you to add them to the investment program when we look at the investment policy. The maturity distribution is going to look a little bit different. We're going to work that through a little bit better. The duration is not going to change very much, but that purchase yield, what you're picking up as a 191, that average market yield, at least at that point, was 427, but it's because when rates rise, so if that market yield is what you would get for that, I should explain that. The purchase yield is what you're collecting right now. That's the rate at which you earn income on an annualized basis into the future based on what you're holding right now. So that's if you think about driving a car, that's the miles per hour that you're driving. And the market yield is a similar measure, but it's not what you're earning. It's what you would get if you purchased this portfolio on the date of this report here. So you're not earning the 427, but the idea is the reason you see it so much higher is because that reflects where rates have gone in the markets. And you can see that because you're earning much lower and the market rate is much higher, it means that you've devalued significantly. And we're going to try to address that. That's one of our primary goals of working with your staff to do that. What you're looking at here are...
Can I ask you a quick question?
Yes, sir.
Back on the portfolio, I thought our value of our portfolio was around 250 million. So is there a differential that we're missing there?
Would you like me to answer that?
No, I thought our total value of our investment portfolio was around 250 million, but it's showing there it's 178. So what am I missing?
We pulled out the Life and Camp. Those are just two liquid pools.
Okay, so that's not included in this.
That's correct. Yeah. The Life and Camp are not assets under management, whereas what's up there is assets under
Oh, I see. Okay. So they're not going to manage that aspect of it. Okay, got it.
And indeed, the cash flow analysis that we've talked about is to help inform staff what the right balance is between those assets that are residing in pools versus those that are actively managed. Those pool assets are meant for meeting short-term liquidity needs.
Right.
So if you generally in the bond markets, if you hold assets short over the long run, you tend to not earn as much as the longer term assets if you're pushing further out. Now that hasn't been the case in the last 3 years because the yield curve is inverted if you're familiar with that. Short-term investments pay more than longer term because of an anomaly of what happened with interest rates after the pandemic. That's reversing, and the normal shape of that relationship is coming back. And that's why you want to optimize what's in here, and that cash flow analysis will help staff inform how much to reallocate.
And so you'll help us with developing that allocation of the short term versus what we're doing here.
That's correct.
So okay.
That's correct.
So that may change over the next 6 months.
That's correct. They're going to look at a cash flow analysis. How much cash do we really need to have on hand? Because right now it's around 70. Do we need that much?
Right.
Of course, the issue is that Life and Camp are both earning, around 4.5%. And so would we want to, sell that off or just reduce it, to purchase these? But they'll do all that analysis for us and make that determination or recommendation anyway.
Sure. Thanks, Ken. Thank you.
What you're looking at here are composites. A composite is a grouping of every single account. So we're not cherry picking here. Every single account that we manage in-house to a very specific mandate. And that mandate is organized around a maturity range and its associated duration. There's that term again that we talked about with those 4 pillars of investments, those 4 levers that I talked about earlier. The one on the left maintains maturities between 1 and 3 years generally. It can go a little longer and a little bit shorter, but the bulk of the maturities are between 1 and 3 years. While the one on the right is longer, between 1 and 5 years. The one on the left generally averages somewhere around 1.7, 1.8 years. On the right, you have a grouping of portfolios that when you average their durations, they're somewhere around 2.5 years. So what we did is we looked at the characteristics of these approaches because that duration number and their associated maturity ranges, those are the biggest determinants of risk and return in your portfolio. For that reason, we tend to constrain that. I mentioned that we pick a target and we kind of stay there. It's meant to work under long-term periods and any interest rate scenario. But the idea is, what I really want you to focus on is the pie charts at the bottom. This is more of what you're likely to look at, what you're going to see in the portfolio. You're going to see a higher increase to treasury bonds because they're the most liquid, and this is a safety and liquidity program. You're going to see an allocation of corporates as of September. We don't have updated numbers because when we put this together, we didn't have the numbers yet. But through December, that corporate allocation is going to be closer to 26%. You see some asset classes that you don't currently hold. Collateralized mortgage obligations, CMOs, ABS or asset-backed securities. These are pools of receivables that are allowed by code. We buy high credit quality deals, and I can get into more into that. Supranational securities, these are World Bank bonds that are AAA rated and allowed by California code since 2014. So this is more of what it might look like, and that maturity distribution will likely be more dynamic. If you look at the yield to maturity, that's the market yield. So that's the yield you would have picked up on that date had you structured a portfolio with new money to look like this. Well, those yields are higher. Those yields are higher today because you've seen since that time rates in the longer end rose, and you'd be looking at somewhere well above 4%. That's significantly higher than the less than 2% market yield or purchase yield that you're currently carrying right now. I want to wrap up with this. This is a disciplined approach to investments. It's very transparent. You'll always see what we do when we execute trades. We're going to be floating the trade tickets to staff. They'll see it. We don't actually hold the money. That's an important aspect that you should be aware of. We actually don't have any access to your money. We can't even touch it. The money, so staff implemented a best practice when they engaged us. And that best practice was to remove the money from the hands of a broker who also sold you the securities. And now that those monies, they reside in a third-party custodian bank in your name, and they're held in, the legal term is in nominee. It just means that it's not counted as part of the assets of the bank, which means that they're bankruptcy proof. They're held in a separate account in your name. The way that it works is when we enter into a trade with a broker to purchase or to sell a security, we exchange that information and enter into that deal with that broker-dealer. We inform the bank. The bank has authorization to clear that trade, process the trade. The bank then does something called delivery versus payment with the broker, where they basically pay for the security and deliver and receive the asset. But we don't touch the assets, and this is how you avoid a Bernie Madoff situation. This is a good best practice that your staff implemented. But like I said, it's transparent. It's meant to promote safety and liquidity. This is not speculative. And you'll see us take these steps. Everything we do is done in gradual moves, so there may be some time to implement what we want to implement here, and then after that it's just a matter of maintenance and repositioning the portfolio slightly, changing the direction just slightly as we anticipate future economic environments and capital markets activity. I'll stop there. That's a mouthful, but perhaps you have some questions for me.
All right, before we go to questions, let's just check with the public. Are there anybody from the public that wishes to make a comment? Okay, seeing none, we'll bring it back to the board. Start on my right. Good.
Because our assets then separate us from their liability of $250,000 worth of
So I think that there's two parts to my answer. I want to answer the easiest one first, which is yes, the assets are held separately from the liabilities of the bank. So, for example, let's take for example what happened with Silicon Valley Bank. They had a run on the bank, if you remember this. This happened in 2023. I was on vacation in Japan answering phone calls at 3 in the morning from Kyoto to all our clients, letting them know that yes, their money was safe because we don't buy. They were too small for us to buy, although they were legal under California government code. So yes, they're held separately. If there were a run on the bank, the bank that holding it is U.S. Bank. If there were a run on U.S. Bank, which is a massive, gigantic bank, they would not. It's not money that they could rely on to go pay off those liabilities. And if the feds shut them down to reorganize or figure out how to make depositors whole, that money would not come into the mix. But to your point, it is still considered a deposit, and under California government code, all of that deposit, just like your deposits at your operating bank, are required to be collateralized, meaning the bank has to hold for every cent that they hold that's in your name. They have to collateralize if it's cash, meaning hold securities that back it. But you can waive the first $250,000 because there's federal insurance. But because these aren't monies, these aren't cash, they're securities, they stand on their own, meaning there's no insurance for any of this. So you really have to rely on the credit quality, on the future prospects of the issuer being able to pay you back, and on the diversification of the portfolio. That's why when you see the investment policy, we've actually reintroduced or introduced a number of risk management policies to really diversify this portfolio and keep it very high credit quality. Let me reiterate, none of the investments that you currently own right now, nor of the investments that we're able to buy on your behalf have any sort of insurance. I'm sorry, it was a little long-winded.
I have a quick one because I think we went and looked at our investment policy. I double checked the date. It was December of 2024, and it sounds like you'll do a due diligence with us and bring us back any gaps. I guess my question is there anything short term that we as a board need to do with that policy in order to support the work that he's talking about?
So Chandler has completed an initial review of the investment policy, and a red line version is in the board's packet for this evening. I am hoping that at some point Carlos could briefly provide an overview of some of the significant changes to the investment policy that are being recommended. If based on the board's feedback this evening, we would like to bring the investment policy back for the board's consideration at the next board meeting so that we can
I just want to make sure we're not in a
right, so we can
okay.
begin implementing some of the strategies that
Great.
Carlos is discussing.
Thank you, because I did like safety and liquidity. That's number one. That's number two. I was seeing a lot of alignment, but it did mention bonds that we issue ourselves, and I wasn't certain where that was in that portfolio as well. So it'd be good to have that discussion. So thank you.
I think he meant they're bonds like we issue. We don't own any of our own bonds.
Any questions?
Nope, pretty straightforward.
Well, thank you for the presentation. Just a few things. So looking at, excuse me, the folks you represent, it's a very impressive list. Couple things just wanted to find out is, when you look at them as a whole, what is your like you look over the last 5 years or so, what has been your general average rate of return for your clients?
Over the last 12 months, depending on what kind of strategy you implemented, if you were longer, you actually did better. In the 1 to 5 year range, they range anywhere from about 3.95 to about 4.05%.
Okay.
And that's a total return. About 2/3 of that, close to 3/4 of that came from interest income. The remainder came from fair value appreciation. Over the course of the calendar year, interest rates in the longer end of the curve fell a little bit, which caused them to appreciate. The last 3 months of the year were interesting. Rates actually popped up for that 3-month period, but not higher than where they started 12 months prior, which devalued investments for that quarter, but for the full year, they ended up in positive, very strong return. Over the long run, it really varies because, if we're talking about an investor that started during the pandemic, they started investing where rates were they were 0.1%, 0.1 In some instances, they were lower than that. And then interest rates rose, which caused reinvestments to come in higher as you reinvested, as portfolios turned over and reinvested. And the longer you are, the longer it takes to do that. But as they reinvested into increasingly higher yields. That rise in rates caused the values on paper to fall, but the future income was growing because they were resetting into a higher rate environment. So it really varies. We don't. I don't want to be hauled out of here in handcuffs by the Securities and Exchange Commission. We can't guarantee returns. But what I can tell you is that over the long run, over a 10, 20, 30-year period, the bulk of your return comes from interest income. And right now, interest rates are the highest they've been in about 15 years. And that's a great environment to be in.
Yeah. No, thank you. Just to, again, I think I don't want to speak for the rest of the board, but I think everyone probably would agree that capital preservation is the key and capital appreciation. One of the things just wanted to ask is, you gave that example. I think you gave the example with the bonds. Let's say if you purchase something at a lower interest, let's say rate of return, and then later on, the maturity is, let's say, 2 to 3 years, but let's say in 6 months or 12 months, those go up significantly. Do you then say you would then maybe take the hit on that, pay the penalty, whatever it is, and look and see what that, because if the cost-benefit analysis, in a sense, if it would be a greater return, to go reinvest into those higher yielding ones, that's the current rate. Is that something that you do, or is that what I heard earlier?
That's exactly what you heard earlier, Director, but within the context of the overall strategy. And that strategy is to target that duration. It means that regularly we'll be rebalancing the portfolio. Every day the portfolio gets closer to maturity. It ages. It gets
Sure.
shorter and shorter. So if we're going to stay within that target range as defined by the maturity ranges that we're talking about and its associated duration, it means that every day the portfolio moves away from it and we have to rebalance to get there. We can do that with maturities, but it means we have to wait for maturities.
Sure.
And we don't know what rates look like when that maturity comes up. That's in the future. But along the way, we know what rates look like, and we can make a decision as to whether those rates are compelling or not. If they're compelling and we can rebalance to our target, and then we do that analysis that you just described, where maybe we take a gain and we reset into a low. If we're taking a gain, it's because rates fell. So we're resetting it into a lower yielding security, but the combination of that lower yielding security income and the gain you took left you with more money than had you just done nothing, then we do it. Or the vice versa. If rates rose, it means that you've had a devaluing of your investment, so that if I sell before maturity, you'll sell it at a slight loss. If that loss gets paid back within a certain amount of time and we end up earning more money with the higher yielding security that we end up buying, if that foots out into the future, then we do it, but all within the context of the strategy. There has to be a reason for every single security in the portfolio to exist in the portfolio. We're not just buying willy-nilly because the yield looks good or because we can take a gain. It has to move the duration to a certain place. It has to maintain a certain level of credit quality. It has to foot out for a certain maturity structure, and it has to foot out for a certain balance between the different sectors. All of those decisions are being made sort of holistically. They all influence one another, and we're looking at that every single day.
Great. Thank you. Appreciate that.
So I do have one. It's got 1.5 actually. So from a cash flow perspective, because that's the deal. When do we need the cash? I'm assuming you're hanging out with Steve and his crew in their CIP plan that says we're going to build digester, 12 in 2042, and we're going to need a big chunk of cash for that, right?
So I haven't had the privilege of meeting Steve yet. But your staff will inform us as to that. So I think of like, okay, what are you working on? Maybe you have to redo headworks. Okay,
Yep.
maybe you're generating power and you got a cogen engine running back there somewhere, or maybe you're redoing. I don't know. I mean, what
Lots of
different
stuff.
parts of the
Yeah.
plant. Okay, so all of that feeds into the cash flow assumptions, and so your staff is looking at that and planning for that. So they're going to withhold back a certain amount of cash from what we
For
described.
the short-term needs.
Correct, because what we're trying to do is what you don't want to do is have to have unanticipated.
You don't want to sell it when
Exactly. We don't want to be forced to sell something. We
Right.
can sell things. This is a very liquid portfolio, but we would rather plan for those sales than to be forced to sell just to generate liquidity. For that reason, we want to reserve money to meet those liquidity requirements. And things like AP runs, payroll, CIP, all these things will factor into that. And this is why staff is a really important part of this program. We don't work in a black box or sort of in our own world. We have to communicate very closely with staff so that what we're doing here supports what they're doing on the finance.
And I was actually approaching it from the opposite direction. Personally, I think we have too much in short term right now. I mean, we plan 20 years out, and we collect funds to support these things 20 years out. I know that the California Code really has kind of a hard barrier at 5 years. I saw a couple of limited ones. Can you kind of comment on that? When can you go longer if you feel it
Absolutely,
in the
because
treasuries?
this is an important point, Director, because we're going to be advising exactly that.
Okay.
California Government Code.
Sorry.
California Government Code dictates the maximum maturity for almost every asset class. Corporate bonds, you can only go out to 5 years. Commercial paper, that's short-term unsecured corporate debt, you can go out to 9 months. Bankers' acceptances, it's a trade instrument with banks, you can go out to 180 days. So there are 4 asset classes where California Government Code is silent. They don't give you a maximum maturity.
Oh.
Those 4 are U.S. Treasuries, federal agency securities, municipal securities, and also negotiable CDs if you can find one longer than 5 years. Okay, we really focus on the first 3.
The
Those
treasuries,
3, they're silent. Code is silent on them.
Oh.
Now there is a separate section of the code, a separate paragraph in 53601.
Right.
Actually, it's an adjacent section to 53601, where it says where code is silent, you have a 5-year limit, unless you have received permission from the governing body of the agency to go beyond those 5 years.
Right.
So we're actually going to be presenting to you tonight, considering going beyond 5 years for 3 of those asset classes: treasuries, agencies, and munis. Initially, you actually had the ability to go a little longer.
Right.
We're just extending it to the other asset classes where you can go.
Because 10-year treasuries are pretty sweet right now. So
Exactly.
Yeah.
And we anticipate that rates are going to fall. With the strategy that we're building between 1 and 5 years with a 2.5-year duration, sometimes if you go just a little bit beyond the 5 years, there's additional pickup. So we're really limiting it. Where you might go much longer, say out to 10 years, is typically when you have a long-term project, long-term cash needs, just something that's going to sit around for a real long time. Alameda County Water District is one of our clients, and that's public knowledge.
Yep.
And we run a strategy between 1 and 10 years for them for a long-term reserve that they maintain.
Oh, good.
And it's a total return. It's actually been very successful. We were able to get in it close to the peak of when rates peaked out. So they jumped in when rates were higher, and it really helped them.
Thank you.
It's been phenomenal.
That clarifies that perfectly. Thank you.
Thank you for your presentation. I guess you wanted to move into the red lines.
Okay, very good. Just checking to see what you'd like me to do. Do we have it up here?
It's in our packet.
Fire up
It's in the packet, but I don't think we have that up for you to pull, Carlos. It might be just slide 9, and then you can refer to the red line.
Okay. So if you allow me to boot up my computer here, it's going to take just a second. It looks like it just kind of fell asleep for a moment. I'm going to refer to it because I have it here.
Oh, there we go. Yeah.
With me for just. So this should be attachment 2 of your board packet, page 20. It starts with page 26 of 59. I don't know if I have a way to share my. Maybe I do. So let's start by saying this. The review focused on first and foremost, compliance with California government code. You complied. You had a very strong policy. Everything is good there. In fact, it was very strong policy, better than most of the policies I see. But you want to always check to make sure that you comply with California government code, that you have captured the most recent changes to California government code, and there are changes almost every year. We track that. And then secondly, you want to verify that you are including best practices that are recognized as practices that will allow you to manage risk over the long haul. After that, you want something that is optimized, that it's flexible enough for us to be able to take advantage of different environments. And then lastly, you want something that's readable. And when I say the word readable, what I mean with that is, as an investment advisor, we want a policy that is black and white. We don't want it to be open to interpretation so that we interpret it this way, but this board interprets it another way. That's a recipe for disaster. We want no deviation. We want it in black and white so it's very easy to understand, readable, and we can implement it, and there's no question as to whether it was right or wrong. So that's what we focused on. There are just a few word changes. I think the first changes are on page 29 of your board packet. It's a section that details what authorized financial dealers and institutions you're allowed to transact with. We added a section that basically, it's straight out of California government code, where it tells you who you can transact with. The intent of the policy is to stand alone whether you have an investment advisor or not. Now, we bring those brokers and dealers that we work with because we have relationships. We have like 45, close to 50 of them on our roster that we work with, that we've developed relationships, and we get good coverage. But if we have to go away for some reason, God forbid, you have to manage this portfolio on your own, and you want to make sure that you follow the law. So we put in there as the law allows it. We put in another provision that's important that I think you should know about. Every trade that we do, or if someone is trading on behalf of the district, those trades have to be done in a competitive environment, meaning you don't just want to buy one bond from one broker. You're going to buy a bond, you're going to shop around 2, 3, 4 different brokers to get best pricing. On page 29 at the top, California government code applies at time of purchase. If you have a security that doesn't meet the requirements of code because code changed, or if there's a concentration limit on a sector, but because you pulled money out and now that sector is beyond the concentration limit because of that change in balance, that doesn't mean that you're not in compliance with code. It just means that you have to kind of hold it until it comes back in compliance, and then you can reinvest in that sector. So all this to say is that percentage limits and credit quality requirements apply at time of purchase. With municipal securities, you did not have this before, but we added a minimum credit requirement of single A or higher. Code requires no credit rating. We want a credit rating. We also added a 30% limit. Code has no limit on those. And then we also added a 5% per issuer limit. So that you're not exposed to any single one name more than 5%. Code has no such limit, but those are best practices to diversify the portfolio. We also included bonds from the other 49 states. California government code changed in the early 2010s for you to allow bonds from the treasuries of the other 49 states. So for example, you're allowed to purchase a GO from the state of Minnesota. Not that I necessarily want one or not, but you can buy it. You can't buy from, say, the city of Minneapolis. It has to be at the state level. We added that. We expanded that to 7 years. So there's your first expansion beyond 5 years. Treasuries, no changes in that other than we expanded it to, we placed a 7-year limit on it. Same with federal agencies. We placed a 30% limit on any single issuer. So no, you can't just buy everything from Fannie Mae. Right. It has to be divided no more than 30% per issuer. We placed a credit rating. No, actually not on that one. We placed a 7-year limit on that one, and we placed a 20% limit on a type of federal agency called a callable agency. Right. I can get into the weeds on that one, but basically they really move your duration and your market risk around, and we want to limit that.
So these maturities, are these the maturities at time of purchase?
That's correct.
Or
at
time of issue. So we can buy a 10-year bond, but you can only buy it when it's been out for 3 years.
You can buy a 10-year bond that has a 5-year right now, unless you implement these changes.
Yeah, I'm talking about like if we, yeah.
Yes, that's correct. So basically, if it has a remaining 7 year
remaining,
bond,
but that's the key. All right.
yeah,
Thank you.
exactly.
Is there a reason? Because you had mentioned earlier that you work with other agencies and you've kind of gone up to 10 years. Is there a reason why we picked 7?
Yes, because the strategy that we're looking at is still very much focused on operating funds, and for that reason, it's better to ratchet back the maturities. You're not taking as much market risk. When you're doing a 1 to 10 year approach, it's really for a specific project or a specific fund of money that is really going to sit around much longer. But the feedback that we received from staff was this is all still operating funds, not reserved for long-term thing. Long-term meaning beyond 5 years. The 7 year is just to be opportunistic. It'll still average around 2.5 years. And in fact, I think there's a limit of 10% that can go out of the entire portfolio beyond that 5 year range. We're getting out a little longer just to dip our toe to pick up a little bit extra yield. It's not a wholesale shift. If it were a wholesale shift, we would significantly change the risk profile of the investment program, unless you have a very specific need to do that, like a long-term liability.
Sure. Okay. Thank you.
Okay. Medium-term notes, we placed again on page 30, we placed a 5% limit per issuer. In practice, we actually don't go beyond 2% in-house. In fact, when those credits get close to 2%, Bill Dennehy, our co-chief investment officer, gets very nervous. Page 31, you allowed for a local government investment pool called CAMP, the California Asset Management Program. It's organized as a joint powers authority, and it sponsors a short-term pool that works. It's very short-term. It works a lot like a money market mutual fund. CAMP is not the only pool in the state. There are other pools, and we think it's wise to diversify. That's a liquidity vehicle, and we think it's wise. So we rewrote that section to include the language from code. But we also, you'll see down the line, we added a section that requires a due diligence review of any pool that you're invested in, and I'll show you that in a minute. We added bankers' acceptances. I said that those are trade instruments between banks. We don't see as many of them, but if the opportunity arises, we do want the ability to buy them. We do have commercial paper. Those are short-term, high credit quality, unsecured debt. You have limits in those. Generally, you'll see those with shorter strategies. If there's a liquidity strategy that's needed in-house, outside of this longer-term approach that we're having between 1 and 5 years, they're useful to have. We placed similar limits around them, 5% and so forth. We added asset-backed and mortgage-backed securities. Those are pools of receivables. That is an asset class that basically you're relying on people who are paying down their debt to pay you back your money. I can get into the weeds on this, but roughly speaking, if you're Toyota Motor Credit and you want to sell more cars, Toyota cars in North America, what you do is you make all these loans to people to buy those cars. But you don't want to wait the 4 years or 3 years or even 5 years these days for an auto loan to get your money back if you're Toyota Motor Credit, because you want to do that again, turn around and do the same thing again. So what you do is you securitize those receivables, meaning you take those monies owed to you, that's a receivable, you place it in a third-party trust off your balance sheet. You sell it into that trust. That trust issues bonds to you, meaning they borrow money from you to pay Toyota Motor Credit so they can go do what they normally do. And then as those debtors in that pool pay down their debt, that debt is paying you back principal and interest. That requires a special kind of analysis. It's not just the name or the credit quality. It's the actual tranche within the deal, meaning that the category that you're getting into, because there's a lot of financial engineering. You have to understand what you're getting and whether you're getting prepayments back and so forth. That's a specialty. And most local government investors don't do that on their own. They hire someone like us to do it. We added repurchase agreements. That requires a master agreement, but those are overnight money market instruments if you ever have to do them. We added a section again on page 33 of prohibited investment practices and vehicles. Some of them come right out of California government code. Some of them are just best practices to avoid. We added on the bottom of page 33 and the top of page 34 a section for due diligence. If you're invested in an investment pool like the state pool, LAIF, Local Agency Investment Fund, or CAMP, or any of the other local government investment pools that exist, someone, and that someone is us, someone has to do a due diligence on it. They have to ask certain questions so that they understand what the risks involved are. You had a section on collateralization. We just expanded on it. We altered on the top of page 35 the section for maximum maturities to extend to that 7-year for those sectors that I mentioned earlier. We added a requirement on the bottom of page 35 that you review this portfolio regularly. That means that we're going to show up here regularly and review it with your staff, so your staff will know always what's going on. And then also you have to measure the performance. How efficacious is this strategy? Is it meeting your goals? Generally, we use a benchmark to do that, which measures the risk taken and the amount of return that you gained for taking that risk on. So we'll do those calculations and present them to you. That's the last one, but all in all, the intent here is to comply with code, include best practices, and have good risk management policies within which we can work to then position this portfolio.
So how often will you be coming back to report on the status to the board here?
That depends on what staff would like me to do. With staff, I'll be meeting minimum quarterly, sometimes more often depending on what's going on. It just depends on how often they want me back.
We'll be receiving monthly bank statements from them and reconciling, from book to manager, and then manager to bank. And so we will have some level of reporting, at least monthly.
Right.
But we need to determine, if we want to go quarterly or, semi-annual, whatever frequency we want to do.
Great. Thank you, Ken.
Let me clarify that. Ask for clarification. So this is a best practice. Don't be offended. You'll get monthly statements from U.S. Bank.
That's correct.
Got it. That also anti-Madoffs this whole situation. And then you guys will provide lots of reporting and analytics and tell us what's going down, and then you reconcile it back and forth.
Correct. And the board will still receive a quarterly report, and that will continue, and the investment policy will be reviewed annually. So between that, we'll be talking to Chandler on when would be an appropriate time to come before the board and report out on performance.
I'm sorry, I have the red line in front of me, and I should be able to find. Is there anything in this policy that specifies that we have to get statements from the custodian, in addition to anything that comes from the advisor?
I don't believe so.
There is a section on safekeeping and custody. It's the bottom of page 34 and the top. Actually, it's just the bottom of page 34. All it is just that it requires the district to have a third-party custodian. That custodian will be providing monthly statements. It's part of the service. If you hire a custodian, they send you monthly statements. And also, Director, for your information, we reconcile to those. Remember I said we can't touch those balances, but we can actually see them. We get an electronic feed, and we reconcile daily.
All right, cool. Good.
I'd just like to say this is a deeper dive into these weeds than we have ever done. And I'm really thankful that you're on board. This was very informative. This was great. Thank you very, very much.
Thank you, Director.
At the same time, I'm almost wondering if it's too much for policy. It feels more like procedure. It's a lot of red, and I don't know how burdensome it's going to be for staff. I mean, my gut reaction is that it's too much and too specific, and kind of prefer the generalities and the flexibility.
A lot of it's required. I mean, so if I had to boil this down, it sounds like we've added everything into the policy that the law allows, because in the past, there was investments we didn't have in our policy. So we've given them that flexibility. They can, and this is one policy that we have to review every year, because
You want to be that transparent.
one, code requires it.
Okay.
Not our code, state code requires it. And two, if it's changing. If we lose an investment that's allowed, we got to get it out of there. If we gain another investment, it makes sense. We got to add it then. I concur, but this is one area where I think a little more specificity is I can't say that word. Specificity is
I just
is a good thing.
because my gut reaction was, it's a lot,
We
and I
typically-
don't want to overcommit, and I don't want to,
We typically don't put in a. I agree. We typically don't put in a policy. Remember to breathe. But in this case, remember to breathe is probably a good idea.
Everyone else is
Yeah.
comfortable with it. I can definitely get on board with it. I just
I'm very pleased with it. I
Okay.
mean, because we really have not gone this far into the details before, and given the current climate and the unknown out there in the market, I think this is great.
Director, if it helps, so everything that you see in that policy that touches the actual management of the securities, all those concentration limits, the minimum credit quality, the issuer concentration limits, any specialty on any names or not allowed, we track that, and we track that through robust compliance systems. Those systems are implemented on a pre and post trade basis. It just means that when Bill buys a bond, if it violates that policy, it kicks it out. And if he overrides it, there's the CEO gets involved. So not only that, but our separate, so I'm part of the investment team, our separate compliance team generates reports whether we're in compliance or not. And they generate basically a report that's a summary of this investment policy that's presented to staff on a monthly basis.
I was going to mention that regarding burden on staff, that I don't believe that it'll be a lot of extra burden. There will be some more burden, that is correct.
Like checkers checking the checker and
Yeah.
monthly things, and they can be done quarterly. Maybe there's development opportunity here. Maybe when your staff is very interested in this, and I'd be all for that. I just don't want to have to hire somebody,
That's correct,
make a
yeah.
bunch of paper copies, and put them in a file, and nobody ever looks at. That's what I'm afraid.
The manager themselves will be doing all the trades and all the transactions, and we will simply get a monthly report, which will be the statement from the bank, that lists all the security investments that were invested in. And then we'll also receive a manager report from the manager. And we'll do our initial reconciliation from the books to the bank. And then the reconciliation to the manager should only be different maybe by some security in transit, like a deposit in transit, something like that. And so the two things should be very close. And then they'll do all the magic and they'll do all the work.
Director.
I have a question. You said earlier something about electronically verifying things. I'm of the generation that doesn't trust electronic. Can you tell me a little bit about your firewall, etc.?
Absolutely. So we use a reporting and portfolio tracking system called Clearwater. So it is a service provider that gets an electronic feed from the holdings in your bank. That feed gets fed to our systems. And so we have the assets. One of the things we did is we worked with staff to come up with a list of what assets were coming over for us to manage. So these are securities, and that they're known by lot. So we have them set up on our system, and we have them set up based on when you bought them and what you're earning and where it is in the cycle of earnings and accruals and things like that. So we're doing certain calculations on them. And based on our calculations, we calculate that they should end up, so long as nothing gets traded, but even if we trade something that gets factored in, we calculate that they should look like this at a certain point in time. And what we do is we're basically getting a feed from the bank telling us this is what they actually look like. All we're doing is just getting information and making sure that what we're calculating is keeping up with what's actually happening at the bank. Now, there's sometimes timing differences, and we have an operations team that tracks these things down. But that's generally how it works. It's safe, secure.
If it's electronic.
Yes, of course. Safe as we try and make it, and we try and make it really safe. Of course, there's no guarantees in the world. I get what you're saying, Director, and I hear you.
All right. Well, thank you for your presentation. Very detailed. I just wanted to make sure I heard you correctly on, you mentioned in 14.0 maximum maturities that there was a red line adjusting the timelines inside of there, and I'm not seeing that red line there, so I just wanted to bring that up.
So it states the district will match its, so this was already existing language that you had, which said no single investment shall exceed a term of 5 years except for the long-term portion of the portfolio at 7-year maturities limited to 10% of the portfolio and to U.S. Treasury notes and others, and federal agency or municipal securities is what we added. So the language was already existing.
Okay.
We just wanted to capture the munis as well.
I just wanted to make sure that there was not a year adjustment, because I believe we're going to be seeing this back at our next meeting in 2 weeks. And
Correct.
I just want to confirm that the board's given the necessary direction. Seems like everyone's kind of in support in favor of the red lines here. Is there anything else you need from this board today?
And Director, and I apologize because you're saying specific dates, specific maturity dates.
Mhm.
In the paragraphs above, at the top of page 5 and the bottom of page 4, there are paragraphs that describe allowed securities such as treasuries and agencies.
Yep.
In those paragraphs, we adjusted and specifically call out the 7 years. We do that for the treasuries, we do
Those I
that for the agencies, and we do that for the municipal securities.
Yes, thank you so much. So,
Staff has everything that we need.
very good. So without anything further, we'll close off this item. We'll move on to item B. Thank you very much.
Thank you, directors. Thank you very much.
So item 8B, receive a presentation on the actuarial valuations of the California Public Employees Retirement System, CalPERS, pension, and the California Employers Retiree Benefit Trust, CERBT, for other post-employment benefits, OPEB, and unfunded accrued liabilities, UAL. Staff.
In October of last year, the board requested a presentation on the district's management of its CalPERS pension and OPEB, otherwise referred to as other post-employment benefits, otherwise referred to as OPEB, and unfunded accrued liabilities, referred to as UAL. Ken Spray, Finance Director, will review the district's retirement benefit plans and UAL calculations based on the latest actuarial valuations. Ken?
Thank you, Jan. Good evening, President Goel, members of the board. So we've done a lot of work to pull all this together and research all these issues, and so hopefully everything will be accurate, with the things that we say and, and the plans that were just the results that we come up with. So anyway, this could take about 10 minutes, and so I'm going to present this, and then, we can answer any questions that you want to ask, at the end. So anyway, with that, we will proceed to the first slide. So tonight's presentation is on pension and OPEB unfunded accrued liabilities. This first introductory slide outlines the types of retirement pension and medical benefit plans the district uses. So retirement pension plans are provided through CalPERS. There are 2 tiers of retirement pension plans, the Classic Plan and the Pepper Plan. The date, January 1st, 2013, is a very important date because it's the date that the Classic Plan became closed to new entrants, and the date that all new member enrollments began within the Pepper Plan. Funding for each of these two plans is different. The Classic Plan uses a fixed 8% for the employee rate, with all other costs of funding the plan paid by the employer. The Pepper Plan, however, splits the employee and employer rate equally, so that saves costs and doesn't increase the UAL, which is classic anyway. The district also uses a 2-tiered OPEB plan. That's other post-employment benefits. The first tier was for medical and dental benefits for vested employees hired before July 1st, 2014. And the second tier was for medical only for vested employees hired after July 1st of 2014. The 2 tiers in both cases of the retirement and OPEB benefits is for cost savings. The purpose of this presentation is to talk about the unfunded accrued liabilities, UAL, associated with each of these types of benefit plans. We'll talk more about this in just a minute, but the short answer is that when the liabilities of a plan are greater than the assets of a plan, you have an unfunded liability. So go to the next slide. So this next slide is entitled Pension UAL. And I will just go ahead and read those bullets. CalPERS prepares an actuarial valuation, or CalPERS prepares actuarial valuation reports annually. UAL emerges when a plan's investment performance differs from actuarial assumptions. UAL changes annually according to investment performance versus assumptions. And then each source of UAL forms a base. That's what CalPERS calls it, a base that's amortized over 20 years. And that's how they do their accounting for that. So to briefly explain how this works, or the bases, in the actuarial evaluation is a table of what they call amortization basis. Each year, a new amortization base is created when actual experience is greater than estimated, a positive experience, or is less than estimated, which is adverse experience. Examples are like investments exceed the discount rate, that's positive, or when investments or assumption changes don't meet the discount rate, that's adverse. Okay. Pension UAL contributions is our next slide. So as you can see, the contributions have gone up significantly from 2015 up to 2023. I might mention that year 2023, that's also the measurement date of the most recent actuarial evaluation. It's prepared on June 30th, 2023, and it creates and sets contribution amounts for the fiscal year 2026. So that's why it's 23. As you can see from this table, UAL contributions for the classic plan have been rising steadily ever since 2015. For the most recent actuarial evaluation, which is the measurement date of 2023, and that's used for the 2026 calculations, the UAL contributions for the classic plan currently are around $2 million. The red markings are the UAL contribution. Those are the little red markings across the bottom there. Those are for the PEPRA plan. These amounts are very small, approximately $28,000, which is nothing. And there's a separate PEPRA table to the right, that red table over on the right. You see the PEPRA contributions, and the dollar amounts of those are very, very small. That the red PEPRA table starts at 0 in the lower left corner, and it only runs up to $30,000, and so quite different from the pension table. Okay. So the next slide is this pension funded ratio. This table shows the pension funded ratios of the classic miscellaneous, the PEPRA miscellaneous, and compares them to the PERF. That's the system-wide sum total of all the CalPERS plans that they manage. 21 was the highest year for all of the plans. 2022 was an unusually bad year for investments, and you see that precipitous drop there. And 2023 shows little change. For the miscellaneous plans. The key takeaway of this slide is that both of the district's individual plans have a higher funded ratio than the system-wide total of all the CalPERS plans. The PERF, the total of all the plans is the PERF. The funded ratio for the classic plan is 80.7%. The PEPRA plan is 88.9%, well above the PERF, which is at 75%. The district made additional discretionary payments for the classic plan for each of the fiscal years 2015, 2016, 2017, 2020, and 2021. And that's the reason why the district is higher than the system-wide total of 75% funding. And then I wanted to kind of jump ahead a couple of slides. I added this slide at the end, and it's a little out of order, but but I wanted to put this in just as long as we're talking about pension. Okay. Classic pension UAL summary. The classic UAL pension basically classic UAL pension contributions are increasing. The classic plan is closed to new entrants. There's a finite number of members within the classic plan that are matriculating through the system, but there's no new ones coming in, and so that obligation will decline over time, but it's not anytime soon, but there will be attrition factoring into this. All new employees are in the PEPRA plan and do not increase the classic UAL. Right now, the district has approximately 60% of all employees in the PEPRA plan and 40% in the classic plan. And 2 years ago, when this presentation was given, it was 55% were in the PEPRA plan and 45% were in the classic. And so we are, gradually moving over to all PEPRA employees. Now to get back to where I was. Okay. Okay, so this
And
pension
before you
funded
move
ratio.
on, I think Director Govinda Rao had a question on
Just-
the
Oh,
PEPRA
yes.
Yeah, sorry,
classic
just a
split.
quick question on, so our UAL seems to be, increasing, correct?
Yeah.
But then the classic, the number quantity are decreasing. So maybe just can you help me understand sort of that correlate, what's going on with that picture?
The number of employees.
Well, no, if you look at the folks that are on the classic plan, they're decreasing, right?
Yeah.
From 45% to 40%,
That's correct.
but somehow our UAL is increasing.
That all has to do with the actuarial evaluations and the assumptions that they use and mortality tables and interest rates and all kinds of things. It peaks up at about $3 million in a few years, according to the table within the classic plan. Just the table that they set up, it's like 2 million up until 2027. Then it increases up to 3 million from 28 to 33, and then it starts dropping back into the twos after 33, and all of that just has to do with the actuarial assumptions that are used, because there's no specific reason stated in the actuarial evaluation itself.
So there's no specific direct correlation between those two.
No, no.
Okay.
As a matter of fact, is it accurate to say that even when we have 0 classic employees still on our books, we will still have a UAL every year?
Yes.
Because until the last one passes away.
That's correct.
Actually,
yes.
until the last one's spouse passes away.
That's correct.
We will always be dealing with a UAL for classic.
Got it.
But part of what we were trying to illustrate, though, is that we are not adding to it
Right.
with adding new members to the classic plan because that plan is closed.
That is correct. Okay. This next slide on managing pension UAL. How do we manage it? So we pay the UAL contribution amount as an annual prepayment. That's actually a discount from the actual payment that would normally be required if we made 12 monthly payments. So we paid at the beginning of the year in one lump sum payment, and it's at a discount for savings over the 12 monthly payments, and we do that. And I believe this is going to give me a check. Yes, it is. Okay, so we do that. Then the next item is to allow gains to offset aggregate losses. And that's true when you get a positive amortization base that negates and offsets the negative amortization bases, and that reduces the UAL in total. And we don't do that. That's the accounting done by CalPERS, but we receive the benefit of it. So that's being done. And then the last item on additional discretionary payments, as I mentioned, that we made those additional discretionary payments in 15, 16, 17, 20, and 21. We haven't done any additional discretionary payments since that time, and we're going to talk about that in the budget sessions in May when we do the budget presentation for possibly reinstating those 15% discretionary payments. Okay. So the next topic is to move on to OPEB UAL. So OPEB is a little bit different. The actual evaluations come every 2 years. With the last OPEB evaluation, there was a small amount, but 73,661 overfunding of the OPEB plan. And then with this most recent evaluation, same culprit, investments again, bad investment performance. So it went from a 73,000 overfunding status to a 3.8 million unfunded status. So it was 100.3% funded, and then it dropped to 88.3% funded. The reasons for the reduction in the funded ratio was more claims. There was like 15 more retirees that were entering into the plan. That means more claims being paid out. Then you're also, funding the plan, for the duration of them and so on and so forth. There's the healthcare trend rate is going up, so there's higher healthcare costs, and then lower investment returns, of course. Liabilities for the OPEB plan now are amortized over a 30-year period, whereas for CalPERS, that's a 20-year period. And the CalPERS, actually, if you're amortizing over a shorter period, that's what's going to make those annual payments jump even higher because you're spreading it over a shorter period. So OPEB investment strategies. It's our investments with OPEB are reside with SERPT. SERPT is the California Employees Retirement Benefit Trust. The SERPT offers 3 strategies. Strategy 1 is the most aggressive. Strategy 2 is the moderate. Strategy 3 is the conservative. The district utilizes Strategy 2. Strategy 2 has a discount rate of 5.6% and an expected return for 24 of 6.1%. So in this case, the expected return exceeds the discount rate, and we should see a reducing effect on the next OPEB UAL actuarial evaluation that we receive. So the final return numbers have not yet been released, so we don't know the amount of the actual reduction at this time, but we're expecting a reduction or an increase in the funded status of the OPEB UAL.
Hey, Ken, just a quick thing. So at the budget workshop, would you be going over sort of what that aggressive strategy would look like and the conservative strategy as well? Just for
sure.
comparison?
Yeah.
Okay.
We might want to switch it back to the aggressive. Certainly. Okay, and so next steps. As you can see from the green box over on the right-hand side, all of the UAL funded ratios are above 80%. 80% is the current policy. Classic miscellaneous is 80.7%, Pepper 88.9%, OPEB 88.3% funded, all in compliance with the financial reserve policy for a minimum of 80% funding. Because of the funding levels, staff does not recommend any action to be taken as far as transfers in at this time. Further, staff will discuss additional discretionary payments at the 15% level of the UAL, of the current UAL, with the next upcoming budget workshop in May. And that concludes my report, and I'll be happy to answer any questions that you may have.
Thank you, Ken. Let's move it to public comment. Seeing none, bring it back to the board for discussion. I'll start off on my right-hand side this time.
Very clear.
I asked all my questions.
Very clear. Thank you.
Perfect.
Thanks.
Thank you very much. I think staff's got the necessary direction, and we'll see you back at our next session at the workshops in May. Moving on to item 8C, we'll continue the discussion of the 2025 strategic plan update. Staff.
District has a 5-year strategic plan that it updates every 2 years concurrent with the biennial budget process. For the 2025 strategic plan update, the district hired a consultant, Wes Yost, to assist with the update. At the January 21st board meeting, Wes Yost presented the first draft of the strategic plan update, and the board provided staff with feedback and comments. Michelle Gallardo was not present at the January 21st meeting, so we gave her the assignment of walking through the second draft of the 2025 strategic plan and discussing how staff incorporated board comments. But I will say she was able to watch the video from the meeting, so I'm sure she is quite capable of doing this.
Thank you, President Goel. Members of the board, I'm happy to take the assignment of presenting to you this evening the update of our strategic plan 2025 and continuing the discussion based on the feedback received for staff at the January 21st board meeting. So this evening we will revisit the timeline, the proposed strategic plan structure and organization of the plan. We'll just quickly review our mission, vision, values, and then we will go over the strategic goals, strategies, and objectives, including the proposed edits based on the discussion on January 21st, and then our next steps. So our timeline, as you recall, we met on January 21st to discuss the updated strategic plan. From that process, staff held a meeting with the full management team in February to discuss proposed revisions and updates and edits based on feedback given to staff. And this evening, we'll provide you an overview of the edits and changes, additions to the draft strategic plan. From that point, we plan to bring back the finalized strategic plan for the Board of Directors to consider for adoption on April 1st. So just to revisit the organization of the strategic plan, it is a visionary and a guiding document. It is inclusive of a board president's message as well as a general manager's message. It has a statement of our mission, vision, and values. It outlines our goals, strategies, and objectives. The process from there is to develop a work plan, which is used by staff for implementation and action of the strategic plan. And that includes goals, strategies, objectives, as well as projects and lead and support departments. So essentially the assignments of activities to support the strategic plan. And I will go through this quickly, but the strategic plan includes our mission, our vision, and our values, which at the last meeting we inadvertently left off the last value statement, which is to perform at a high standard. It is currently a part of our values statement. And so we are proposing a consolidation from the 10 goals we currently have to 6 goals, as you see here, and I'll go through each one with the proposed edits to the strategies. So the first goal is for environmental protection and regulatory compliance. This goal is to meet or exceed environmental and public health standards while preparing for the future regulatory landscape. There were no changes proposed to this first goal on strategies A and B, so they are as they were presented at the January meeting here.
Michelle, can we go back to the the couple slides back? We had 7 bullets. Now we have 8.
Oh.
One more.
Oh, sorry.
The values.
Yes.
Why did we add the new one? I thought 7 was too many. Now we have 8.
So we actually currently have 8 value statements. We just, for whatever reason, it was an error.
Okay, so
that we left it off inadvertently. Yeah, no,
Okay.
it's not. If you were to go look at our strategic plan on our website, it's inclusive of that statement. We just left it.
I guess my question. I mean, that just feels like What's the difference between providing high quality customer service and performing at a high standard? And it feels very, isn't it a given? I mean, I don't understand why that's there. I didn't miss it.
This, and if you recall from the conversation with the consultant, this is one of the areas that we are going to look at in the next year. The consultant did observe that there's some overlap between our values
Yeah, I
and
kind of
our
expected
goals.
that we were going to collapse these, not find one we didn't talk about that no one
It was
noticed.
actually staff that pointed it out as we went back to full management. And so, as part of this process, we would want to work with staff to pare down the values.
Yeah, because it could easily say provide high quality customer service at a higher standard.
I mean, how do you define high?
Well, yeah.
I just, to me, it's like, obviously, I don't want you performing substandard or poorly. I don't know. I'm sorry. I appreciate you going back so that I could say what I needed to say. 'Cause I was really stuck on that. And I totally didn't hear the rest of what you were talking about. So thank you for providing that explanation, but low value. Thank you.
Thank you for the feedback.
Sorry. So back to our regularly scheduled program.
No problem.
6 goals.
6
I'm
goals.
with you. All right.
So again, we did have 2 strategies for goal number 1. They were unedited in this second draft or second review. Strategy A is to minimize impacts to the environment by reducing recycling and conserving natural resources. And strategy B, to operate and maintain district facilities to meet or exceed regulatory requirements while preparing for the future regulatory landscape. Our second goal proposed is long-term financial stability and sustainability to manage the district's finances to meet funding needs and maintain fair and reasonable water and wastewater rates. And there's 2 strategies proposed here. We did make edits to strategy A, ensure financial sustainability through long-term financial planning. You'll see the adjustment on the second objective, which is to plan for rate adjustments that are steady, predictable, and based on our business needs. And then strategy B, we also made an edit to the second objective for enhance accountability and transparency in financial management. Now reading regularly update financial processes, procedures, and policies to optimize management of the district's finances, including debt, reserves, and investments. For goal number 3, we made some edits to the actual goal statement as well as the strategies. This is a workforce development and planning goal to maintain a culture that attracts, retains, and engages a safe and high-performing workforce in support of the district's mission, vision, and values. We actually, I think we moved this strategy from another goal over to this one based on board's feedback. Strategy A now reads to sustain a robust safety culture by continuously updating the district's environmental health and safety programs with 2 objectives stated underneath, which is to regularly review and update safety policies and procedures to ensure compliance and relevance. And the second objective is to provide ongoing safety training and resources to equip staff with the knowledge and skills to maintain a safe workplace. Strategy B also has some edits proposed to now state diversify and strengthen the skills of district employees to meet evolving workforce demands. Objectives were also edited here in the third bullet to strengthen the management and leadership program for employee career and professional growth, and then adding a 4th objective to leverage technology and foster innovation to elevate the skills of district employees.
It was a big one for you. Are you satisfied with them breaking it out?
The third strategy for the workforce development and planning goal is to plan for succession of key positions where feasible. We made an edit to the second bullet under objectives, update recruitment and selection standard procedures to optimize employee performance and retention. And the last strategy, there were some edits to this, stating promote a district culture which encourages learning, innovation, teamwork, and recognition. We made some edits to the objectives, which is to provide opportunities for employee engagement through programs and initiatives which align with employee interests and supports teamwork. The second bullet reads to promote employee recognition programs, which acknowledges employees for high-level performance and contributions to the district and industry.
So going back to my original point of performing at a high standard, if everybody's supposed to perform at a high standard, bullet number 2 means we recognize everyone. Because they're going to be doing that as an aspirational goal. So I'm just making a point that you're kind of stating that here. I like it here. I just don't know that it adds value. Where
That there's some overlap and duplication.
Yeah.
I would agree.
I like that this is actionable.
Thank you.
If I could clarify, Director Johnson, are you asking staff to relook at the values at this point? Part of it was just, it was a matter of time, the effort to relook at the values with staff. We weren't sure that we could fit that into the timeline for this year, and we were going to do it sort of off cycle.
I think my point is that I didn't notice that it was missing. I'm not sure that it's high value to add it in at this point.
Okay.
Unless someone else thinks it's very important, I would just suggest that we delete that. I don't know that there's an action item to look at all of them and collapse them and wordsmith them. The other 7, although I think there probably are too many, did seem to hold their own. I think that was the point I was trying to make.
Okay.
And you kind of covered it with that recognition. So you're highlighting that level of accountability there was something that I think we can measure versus a bullet that I don't understand how I would know that we did it.
Can I just make a quick comment? So just, I think the reason, it was brought back in is because it was an oversight. And the question now is, are we like, does it even make sense? And I think just going back to the values, when you look at any values, they're going to be more subjective. I'm not saying we should add it or not add it. That's not my point here, but they're going to be subjective. They're not, probably at that level, when you discuss values, it's not going to be where you're going to have measurable stuff in that area, because it's usually more of a subjective thing. It's when you get into the goals is where you get into more of the measurable of things. So that's, I'm pretty indifferent about it. If we want to remove it, that's fine. If we don't, I'll leave it, if the staff wants to go back and look at it and see, that's,
And that's the right term, is remove it, because it was inadvertently left off last time we saw this. Now, staff may have just gave us an opportunity to edit because it was inadvertently left off and we didn't notice it, we didn't care. Maybe we just keep leaving it off. And I think we make that decision tonight. We don't need to do it. I'm fine losing the 8th bullet point. It doesn't add a ton to me, and it wasn't there last time and nobody noticed it. My 2 cents.
So you got 2 head nods in that direction. I think, the real thing here is, in order to meet the objectives of the timeline, and I guess also not to have a disconnect with staff, right? And I'm talking global staff at this agency. Do you guys feel there's an opinion that staff would be dismayed if that bullet were to be removed?
I would prefer, if the board didn't feel strongly, to keep it in, just because we did not have a conversation with staff about making edits to the values. But If the board feels strongly, I think we can also go with the board's preference.
So I think the question to maybe those that are in the head nod is, I think there's a value statement literally being made about that particular value, and as long as there's no one that feels strong enough to kind of take a direction on that, we allow them to revisit that in the next cycle.
4 years from now.
Won't the next cycle be a final of this?
Well, next review cycle where they were planning on consolidating.
I think they're looking
et
for
cetera.
showstoppers without meeting and come back and we vote on it in 2 weeks.
And we do this every 2 years.
Correct.
I don't know. I'm much more of a practical person. All these nice words that are in pieces of paper that somebody's supposed to read and adhere to never get looked at. So I don't care if we take it out or put it in.
So you got 3 head nods. You good with removing it?
I'm okay either way.
Okay. So staff, I think you got your direction.
Very good. Thank you very much. Our next goal is goal number 4, resilient and effective operations. This goal is to improve the resiliency of our operations against emergencies and future uncertainties through planning long-term partnerships and integrating technologies that improve the efficiency and effectiveness of our business processes. There are proposed edits to the strategies. Strategy for strengthen emergency preparedness and response plans for responding to internal and external incidents. We also made edits to the second bullet, which is to optimize and invest appropriately in emergency equipment, materials, and supply contracts. And strategy B is to increase the resiliency of district water supplies and operations through long-term partnerships. There were proposed edits to the objectives. First bullet states partner with agencies to explore and implement options to diversify and improve the resiliency of our water supply. And the second bullet reads update joint powers authority and interagency agreements to provide a vision and framework for meeting future program needs. Strategy C is to update and maintain a long-term plan to guide technology and technology investments and resources. And we added a third objective to fortify our digital infrastructure and strengthen knowledge and tools needed to protect against risk. Our next goal is long-term infrastructure investment. This goal is cost-effectively manage, maintain, and improve infrastructure to deliver sustainable, reliable, high-quality service now and in the future. There are 3 strategies for this goal. Proposed edits for Strategy A: prepare comprehensive facility master plans to guide long-term infrastructure investments needed to meet future demands. And we added a clarification to this objective at the end that this applies to meeting defined service level requirements at build-out. For Strategy B, optimize the asset management program to guide district business decisions. We proposed edits on the second bullet stating leverage asset management data to determine criticality and maximize preventative maintenance to extend the life of assets and budget for long-term capital replacement needs. Strategy C, manage and implement a prioritized capital improvement program to address long-term infrastructure needs. No edits were proposed to this goal. And our last goal is customer service and community engagement. Foster confidence and trust in district services through quality customer service, community engagement, education, and partnership efforts. Strategy A is to provide quality service and timely information and resolution of customer inquiries. We made edits to the 2 objectives, formalize a customer service program that provides efficient management through technology, enhanced quality, and proactive customer service that measures performance. And the second bullet added, continuously update measures to protect customer data and other personally identifiable information. Second strategy is to build public awareness through outreach and education of district services, priorities, and initiatives, and no edits were proposed to the objectives for this strategy. So again, we have our 6 goals proposed for our strategic plan. Our next steps is to incorporate any final edits as discussed and directed to staff this evening. And we will be planning to bring back the proposed strategic plan to the board for final adoption on April 1st. And with that, happy to answer any questions.
Thank you. Let's move it to public comment. Seeing none, bring it back to the board to, go ahead, George.
I just like to say I apologize for inferring that nobody reads the document. I realize that it's our job to create a framework by which the employees are supposed to carry out the business. I just get very frustrated with wordsmithing. I think our job, and I know this is unrealistic, but I think our job should be obvious. And I know sometimes it isn't, and things have to be written. I think staff's done a great job of paring it down to things that are simplistic and understandable by everyone. And again, I didn't mean to infer that staff's not out there trying to do the job as well as they can, as we are. So I'll just leave it at that.
Director Johnson, any further comments?
I like the new icons for the 6 goals. I think they're much more relevant to our business, so nice choice there. No additional comments.
Thank you, Director Von Heater-Leopold, for that clarification. I think it means a lot to staff to understand it. They do take this stuff serious, and I think they honestly do live by it. So, Director Govinda Rao?
No, I was just going to say, nice job. And in 2 years, we're probably going to pare it down to 3 goals, right? Just kidding.
Director Halkett?
Nope. I like it. Go to press.
All right, just a couple of comments on that last bullet being removed. To share the values with the staff when you go back to them with that is all of those sentiments are embedded inside of the goals. And I think they should kind of recognize that and know that their values is not being disconnected. On item 4C, that last bullet, I hate to do this. I think you can get rid of one of the ands and put a comma or something in there. I hate a run-on sentence. So, just a pet peeve as we're supposed to be setting our high standards here. With that, we'll go ahead unless there's any additional comments. We'll move on to item 9. And by the way, staff, all good with direction from the board? Okay. Moving on to item 9, reports. We'll go to board items. I believe there was a Joint Powers Authority meeting and a committee report for LAVMA. Director Govinda Rao, you want to take it up first?
Sure, I'll take it up and then you can bring it home. So we had the LAVMA meeting on February 19th. Is that correct? Yeah, February 19th. And just a few things I want to share with the group here is we recognize Mr. Robert Carling, who served, on that committee and also termed out as, the Livermore council member. We welcome Stephen Dunbar, who took the oath of office as a new member. The board compensation ordinance was approved, as we discussed last time. Some other things that we discussed as well is they gave an energy management presentation was given and regarding enrolling the electric service into AVA, just like what we're trying to do here as well. So they did a look back in 2024. The savings would have been approximately 100,000, and DSRC would have saved 22,000 and change with that. If going back and looking if they were in that program in 2024. The capital projects, just wanted to mention the San Leandro Sample Station project had a completion date for August 2025, but due to supply chain delays of a 30-inch control valve, it's going to be pushed out further, probably somewhere they're looking at in fiscal year 25-26. And the last thing is there's a little bit, well, the FEMA reimbursements for I think the repairs of the storm drains are put on hold currently due to the federal freezing of funds. And there's right now a current lawsuit with various states suing the federal government. So that was also discussed at the meeting. I think I covered most of the items, but there may be one or two I may have left out.
I think the only other one was the recovery of the funds that Livermore was trying to go after for that bank repair. Might be at risk. So they're going to continue to retain the consultant to support that, but that's part of the potential impacts.
Is that the FEMA money?
Yes. Yep.
That hasn't been resolved yet? Don't have a check yet?
Well, FEMA kept on coming back with clarifications, and then now it's
Okay.
stuck.
You were talking about that last year. I thought that was.
Yeah.
Now, has it officially been frozen, or are we just making assumptions based on the current media?
I think there is not making assumptions. I think there's a
They've
holdout.
gotten a letter from somebody.
No, there's no response back.
I see. There's nobody to respond.
Kind of maybe something like that.
Okay.
So a little different edge of the sword on that one, but they're going to continue to retain the consultant to support as and when needed.
That's just a point of clarification. That's a reimbursement issue, right? That's not something that we would need to budget for in order to make Lavma whole in the future.
A reimbursement to
Okay.
Livermore. Right, that was an action that was taken over there.
You've expended those funds. It's a big chunk of change. I was just,
It's like in the
I
magnitude
just
of
wanted to
4
make sure my
point something.
recollection was correct. Thank you.
I don't believe there were any other joint powers or committee reports. So moving on to 9A2, a submittal of written reports for days of service events attended by directors. Written reports are due this evening. Does anyone have any report? Director Juanita Leopold.
Yeah, I have a couple. The first one has to do with CASA. We had a board meeting the day after our last meeting, and we didn't do a whole lot of business, although we did approve CASA being the fiscal agent for two special projects. One is the HDR nutrients project, and the other one is OAH NWRI project, and both of them have to do with special studies that are going on right now, and these separate funds need to be accounted for, and there's nobody out there to do it unless an agency takes it on. So CASA has taken it on, and fortunately it's not an extra burden for the accountant that CASA has. The other item of import was that we have hired an external legislative, we sent out an RFP to hire a external legislative advocate because things that are going on right now are
Changing
a
quickly.
problem, and we need somebody else out there to advocate for PFAS and the biosolids, and those are both federal issues with EPA, and since we don't know what's happening, we've given Adam the authority to hire an additional advocate to speak at the federal level, because both of these, as we all know, are very critical to our process, our agencies. And then the other thing is that we sent out an RFP for a new auditor, because we've decided to change auditors every 3 to 5 years, as is now common practice. It used to be that you stayed with the same auditor because they were familiar and the price could come down, and but that's all changed now. You know, you don't. There's no loyalty anymore. You change. And then the Castle Winter recap, we had again the highest number of people there. There were 318 registrants. There were only 10 no-shows. And then we are partnering with CSDA on the California Legislative Days for May 20th and 21st, in case anybody wants to attend and participate. And that's all from CASA, but I have one other. I also attended the Chamber of Commerce Economic Development Committee meeting and have a couple of comments there. Well, there's quite a few actually. The chief of police spoke, so it's kind of interesting to get his perspective on the new things that are going on. They've put in 85 new intersection cameras. So don't go try and run in red lights in Dublin because they're going to catch you. Dublin and Livermore have the upgraded technology to handle these new cameras that apparently are much more able to be read, that you can read things easier, you can see the face easier. It goes through facial recognition, can go through facial recognition. The other thing is very interesting. Alameda County Sheriff's Department has 2 planes and 2 helicopters at their disposal to run around and look at things. And of course, that's why you see so many questions on Nextdoor about helicopters, because not only ours are up, but the Army's are up, East Bay Regional Parks are up, and so it gets very, very busy. It was interesting for him to relate that we have no gangs in Dublin, which I found very surprising because there's been so much going on at Dublin High, but he insists we have no gangs. Representative Swalwell was able to get a grant so that they now have a third behavior therapist on their team. So we don't just go out and arrest somebody, we get the more help involved at that point if we're dealing with someone that's, not having a good day. Let's call it that. The biggest problem we have was retail theft. Even though we see all this about car break-ins and whatever, and the biggest problem areas are Dick's Sporting, Ulta Beauty, and Target. Again, I found that very interesting. He insists we only have 5 to 10 homeless. I haven't seen too many, but that's what he said. They're also having a safety fair at which Zone 7 is going to participate on May 17th. So we may want to look into that so we can participate. It's going to be at Shannon all day. It's a community safety fair. 10 to 4. Let's see, there was one other item. Okay, I'll think of it. But, oh, I know. No, I said that already. Sorry. I just recalled it. I'm speaking from never mind. We were told here that we should report to the sheriff's office emergency EOC in a situation, and he counteracted that. He thinks we should be going to the Dublin EOC, which is at the sheriff's department here. So maybe that's something we need to work out with the city of Dublin, just so we know where we're supposed to go. That's it.
Thank you. And I just want to maybe seek clarity. I don't believe we have red light cameras in Dublin. I believe these are license plate detector cameras.
No.
Because we don't issue fines.
These are license plate readers and situational situations where they can see an accident happen
Correct.
in an intersection.
But they're not red light citation cameras. I just want to make sure we're on the same page on that one. But yes, they're situational, and there's a retention policy at the City of Dublin in
Right.
regards to that. So don't want to stir up the wrong message. All right. Any other reports? All right. Moving on to 9.8.3. Request for new agenda items be placed on a future board or committee agenda. Does anyone have any items?
I do. I'm sorry.
All right. Go ahead.
This may sound really silly after I just commented about paperwork and policies, but do we have a DEI policy? And if so, what are we going to be doing with it? And if that's way off the agenda, it's fine to put it on the next agenda. Just a question.
To the general manager looking at me, and I think I can answer the question, is the district has no such policy.
Okay. Thank you.
All right. So is there any request for any item? All right. Just seeking clarity. All right. Moving on to item 9B, staff reports. Staff.
March is a busy month, so I would encourage the board to look at the calendar of events. I just wanted to highlight a few. The State of the City for San Ramon is tomorrow, Wednesday, March 5th. The City of Dublin St. Patrick's Day Parade, of which we have some pretty good signups for both the board and staff, is Saturday, March 15th. The Pleasanton State of the City is scheduled for March 25th. There were two liaison meetings scheduled for March. The Dublin liaison meeting needs to be rescheduled, but the Pleasanton liaison meeting has already been rescheduled to March 31st. So just be on the lookout for these rescheduled events on your calendars.
I think there was also the Zone 7 Chain of Lakes.
Correct. And an invitation should have gone out directly to the board on that one.
Do we have a pending meeting with Central Sands?
We do not.
Do we need one as summer approaches with regards to making sure we've got all our ducks in a row for diverging water or whatever, stuff out at the high school? Is that agreement still in place? Do we need?
That agreement still is in place. We have 1 year left on the temporary agreement, and then we're working on the long-term agreement that would take, once executed, would take over.
Okay, so you don't need any board support to make sure that agreement
Not
gets
at this.
extended. I'm sorry, it was just like
Not at
that
this
was what
moment,
knew
but
we
I
were coming
will.
up towards an expiration. You think the wheels have been greased? We don't need to all sit and stare at each other to make sure that there is a meeting of our minds with regards to that.
I will check with Central Stan and we'll talk about whether and what the timing might be of a future liaison meeting.
Okay.
All right. Thank you. With that, we'll move on to item 10, closed session. Just please be reminded, put your mics on mute. Thank you. And we'll retreat to the board retreat room. Thank you. The board meeting is back in open session. The closed session has concluded. There was no reportable action taken in closed session. The meeting is adjourned at 8:20 p.m. Have a good evening.